Welcome. This is Bert Dohmen with Making Money, August 2nd. We had a very interesting week. The biggest one-day decline in the Dow Jones Industrials occurred, with the DJI going down 317 points in one day. So obviously there's some interesting things happening now. Let's see what a couple of charts tell us what might be happening. Here's a long-term chart. It goes back to 1992, actually, of the S&P 500. There is symmetry in the markets always, and it's just a matter for us to try to discover them. And here we have different time periods going from the bottom in 1994, and they're actually, it's kind of a double bottom, and to the top in the year 2000. There was the first top in early 2000. In March, and then another one later in September. So we have to decide here which are we going to take. So there are three different time periods outlined here, but let's take the one that's I find kind of interesting right now, and that's this one here, going from the blast off in the market in 1994, where this big bull market started, to the top in early 2000, which I consider the real top, because that's where the NASDAQ composite also topped out. Was March 10th was the peak, was the exact day when we said this will be followed by a crash in the market. So we caught that one exactly to the day. Then we take that period, that's 5 years and 3 months, you can see that here, and we add that to the bottom here, March 9th in 2009, which was the bottom of this global crisis crash. And we use the 5 years, 3 months, and where does it get us? It gets us exactly to where we are now. So, it doesn't have to repeat exactly, but it's certainly a good caution signal, a warning that there's high risk in the markets right now. Let's take a look at the relationship between the small cap stocks and the S&P 500 index. The S&P 500, as you know, are the big cap stocks. And the IWM here is the ETF for the Russell 2000 index. And the Russell 2000 is a small cap index. So these are the small caps. They're very speculative. They're very overvalued. At the peak here just a few weeks ago, the PE ratio was 84. 84 is a very high price earnings ratio. The S&P is around 17. So it's drastically overvalued. And there's something in the markets called reversion to the mean, when the spreads get out of line between the small caps and the big caps. And then the markets will return to normal relationships. And here we can see the market from 2003, actually, where the IWM, that's this line, that this is a candlestick chart, and blasted off, and this thinner line is the S&P 500 index. And you can see as the bull market advanced, the spread between the small cap stocks and the S&P 500 got wider and wider until it finally got to a point where there was really no value relationship anymore between the small caps and the big caps, and the small caps just really collapsed, and that was 2008. But of course, during that time, the S&P 500 also declined about 57%, but the small caps have got absolutely demolished. And now here we see the bull market, 2009, and we see this bull market starting. And here's the S&P 500. That's done very well, as we all know. And here is the spread between the small caps and the big caps. This difference, this spread right here, is the biggest ever in history. Okay, when a spread gets this wide, this far away from reality, it's like a rubber band. It's been pulled too far and it snaps back. And this is what we should be seeing now. So here's another big warning signal in the markets right now. I want to thank you for joining us today. Come back again. We're going to do these more often, just a few charts at a time, so we don't bore you to death. And here you can check out some of our services, domencapital.com. That's our website. Then we have another website for a special new program called Hedge Folios that allows you to be your own investment manager. Thank you again for being with us today. This is Bert Dohmen signing off.